Kathy McKinnon.
Here.
Jared Smith.
Here.
Glendwyn Thames. George Perez. Sarah Sanders.
Here.
Okay, so we have 4 committee members, including yourself, Jared, in attendance. I didn't call Franklin Perry because he informed you that he's not in attendance. He will not be joining us. And we didn't hear from Tim, Glenn, and George.
Okay. All right. Well, we got convening the meeting, and we got 2 action items to commence preparations for bonding and a few reports to go through. And I'll hand it over to Dean.
Okay, thank you. Good morning, everyone. Hope everyone had a great summer. So like Jared mentioned, we do have 2 action items to get approval on from the committee. Okay. And then we're going to, I'm going to hand it off to Ed. Before that, Sarah, Amy is having technical difficulties sharing the screen.
That's fine.
Okay,
Okay.
I'm going to continue to try. I just don't want to disrupt you all. I'll stay in touch, Hazim.
Nasim, I don't know if you noticed, but a couple of new board members just joined.
Yes. So I want to acknowledge Commissioner Perez. Are you on?
Yes, I am.
Okay. And Glendwyn Thames?
Yes, I'm here.
Thank you. Okay, Ed, you want to start with your action item?
Good morning. You have in your package the standard single-family resolution to authorize the issuance of bonds to continue funding single-family home ownership. While this would be the 4th issuance for the year 2020, it will be the 3rd permanent issuance for single-family. The second bond issue, the 2020 Series B bond issue, was a $75 million taxable temporary bond issue. It's scheduled to be redeemed October 1. This resolution is for the issuance of up to $235 million of bonds. The actual amount of bonds to be issued for lendable proceeds is expected to be around $80 million. The remainder of the issue, its issuance authorization, will be used for refunding previously issued bonds. The bond issue is expected to close by the middle of November, but will depend upon market conditions. Bank of America Merrill Lynch will be the book running senior manager for this bond issue. Does anyone have any questions?
Is there a motion to approve it?
So moved.
Is there a second?
Second.
Does anyone have any questions or comments?
It's Jerry Abrahams. One question with respect to the refunding. Is there I didn't see it in the resolution. Is the resolution specify criteria for savings on the refunding bonds, or is the refunding being done for structural reasons?
No, the refunding is done to save debt service payments. What we're seeing is quite a few prepayments coming in. That's why there's a large amount of refunding. So we're going to refund those bonds to use negative arbitrage and specifically to save volume cap. So we'll refund these bonds on more of a short-term basis, and then we'll refund them again when we need them for permanent loans. So it's 2-part. One, to save cost. There are high coupon bonds out there. When the prepayments come in, we're going to earn stiff rates, which is 20-ish basis points, while we're paying several hundred. So we'll save debt service, and then what's just as important, we're also saving volume cap by refunding the bonds now, and then we'll refund them again sometime in the future as permanent bonds. So there's 2 things going on here: saving debt service and preserving volume cap.
Okay, Jerry. Any other questions? All right, if there's no other questions, it's been moved and seconded. All those in favor say aye. Aye.
Aye.
Do you want to do a roll call on this, Hazim?
I think that's the protocol, so we might as well.
Okay. Let's do that.
Jerry Abrams,
Aye.
Tim Hodges,
Aye.
Tim, you're here. Okay. I see only Moto Z4.
Aye.
Kathy McKinnon,
Aye.
Jared Smith,
Aye.
Glenda Thames,
Aye.
George Perez,
Yes.
Sarah Sanders.
Aye.
So it's unanimous.
All right, move on to the next one.
Ed?
You also have in your package a resolution to authorize the issuance of up to 60 million of bonds to fund up to 11 group homes and to refund outstanding special needs housing bonds. These state-supported special obligation bonds are issued under the special needs housing bond indenture. These bonds are limited obligation to the authority, with debt service payments coming from the state via the Department of Social Services with regard to room and board payments for group homes, and directly from the state being a state assistance agreement for supportive housing. The last time we did a bond issue under this indenture was in 2018. The bond issue is expected to close by the end of the year, but will depend on market conditions. The senior managers for the sale are Roosevelt and Cross, which will be the book runner, and Samuel Ramirez. The bond counsel on this issue will be Robinson and Cole. Does anyone have any questions?
Is there a motion to approve it? And is there a second?
Second.
Any questions or comments?
Actually, I had one question about this in terms of sort of the number of companies involved in doing these bond sales. Does CHFA look to use majority minority companies at all when doing bond sales?
I mean, every 3 years, there's an RFP out for underwriting firms. There's a process for reviewing these, and then there's a discussion at the board, the finance audit committee, and then the board. And the board votes on it. In this case, the minority firm in this one is Samuel Ramirez. So they actually, the last time we did it in 2018, they ran the books, and this time Robinson and Cole. So they are a senior on this. And
Okay.
It is taken into consideration. We'll probably be doing an RFP going out sometime next summer. So have input then.
Great, thank you.
I had a similar question along the same lines. Usually we have, it's a larger bond issue and a larger selling group. This is a much smaller selling group. Was there a different process for selecting this smaller group?
It was a subset. It was part of the same RFP. It's a bond issue isn't done very, it's done occasionally. Last time in 2018, I think it was 2016 before it. So it's not done. It's actually off the state's credit. These bonds will be rated from the state. And the idea back then was to try to get local firms or minority firms involved. And that's why we have the syndicate we do.
Okay.
I have a question. Once we did an RFP, we come up with the list. Do we rotate them or?
On the regular housing mortgage finance program, yes, we select 4 seniors with the idea that we'll do 4 bond issues a year, and each one takes a turn. With the special needs, we did 2 seniors, and they rotated.
Right. So not to put words in your mouth, but their turn came up. It's not like you selected them. I mean, you select them through the RFP process, but then you rotate them.
Yeah, exactly, yes.
Okay.
Any other questions? All right. Well, let's call the roll then, since it's been there was a motion.
Sure.
Seconded.
Jerry Abrams. Tim Hodges.
Aye.
Kathy McKinnon.
Aye.
Jared Schmidt.
Aye.
Glenda Wynn Thames.
Aye.
George Perez.
Yes.
Sarah Sanders.
Aye.
So it's unanimous.
All right.
Okay.
Thank
I
you.
just want to, before we go to the next item on the agenda, I just want to note for the committee, the board chair would like to change in terms of how action item is presented at the board meeting. So what's going to happen is I will be presenting both resolutions to the full board, but I will only be summarizing what got discussed this morning. And my plan is just to mention about, or at least bring up the questions that were raised by the committee and also inform them of the outcome. So I will inform them that the committee voted unanimously approving each resolution. So I just want to inform the committee.
How's that different from what you've done in the past?
Well,
I mean, you haven't been as consistent, but I mean.
yeah, no, I understand. I understand, Commissioner.
Okay.
So we'll see.
Away from the chairperson, but
No.
What's the big news?
It may. I think it will affect more the items coming from mortgage than from finance. But this is our first try. So any feedback, is appreciated. Okay, so the next item is regarding is a report on the 2020C bond that we closed in August. Since we did not have an August meeting, we're presenting it this month. Here with us this morning is Corey Hapner from RBC, who's going to give you some color about what transpired during the sale. I did include a memo to go along with the pricing book. As you can see, I did discuss about this particular transaction and what's unique about it. There are a few things that's interesting. Number one, of course, this is our first bond sale post-COVID. Number two, in connection with the sale, it includes a refunding of a short-term bond that we did back in May. If the committee members remember, when we were, we had a schedule, just like what Ed was mentioning. We typically plan to issue about 4 sales in a year. And when we were pursuing the second sale, we encountered COVID. We encountered a lot of headwind in the marketplace. We didn't like the interest rate. That there was, bonds were being priced at a huge discount. So we ended up pursuing a short-term financing. We did seek some bids from financial institutions. Those same financial institutions were also considering requests from different states, including the Commonwealth of Massachusetts. So we did pursue and receive the lowest bid from RBC, who then bought and provided us with the short-term bond. And then through that whole execution and with this refunding, we essentially save about $8 million from a present value basis, because we did not pursue the original financing back in April. So without trying to steal all the thunder away from Corey, so Corey, why don't you describe the sale itself?
Yeah, thank you, Hazim, and Mr. Chairman, members of the committee. Appreciate the opportunity to visit with you this morning. I think Hazim hit it on the head. You know, CHFA fell prey to a recession that was brought on by government decree relative to a recession brought on by macroeconomic distress. So obviously, you know, folks were acting quick to address the issues around the coronavirus. And, you know, we were proud to step up as your partner and provide this interim funding in order to bridge the gap on the loans that needed to be funded at a time when, you know, there was a severe dislocation in the market. So this transaction was originally scheduled to be brought to the market by B of A, and you know, RBC stepped in, as Hazim noted, with the interim line and such, did the takeout here back in July. So, you know, it was an interesting time, I think, for all of us. The draw on global credit at that time, when everything had, you know, basically been on hold for 45 to 60 days. We were looking at, you know, originally a pricing in late April, you know, on bonds that ended up pricing in late July. At that time, you know, there are 66 PAC bonds that have been done so far in 2020. And, you know, the year started out with a 160 PAC bond rate. Connecticut HFA did a PAC bond in February that was a 144 yield. And as part of the COVID crisis, that bond, had CHFA priced it in late April as intended, would have been in the 2.3% range. And so really, you know, kudos to the CHFA team, and in particular, you know, Hazim, Ed, Lamont, and others, who decided not to chase the market at that point in time. You know, the severe dislocation was brought on more by fear and less about credit or issues, you know, involved in CHFA's balance sheet or CHFA's program. And so folks that were forced to issue bonds at that point in time were paying a significant premium. So the ability not only to look out and say, yes, we want to access the market, but we don't want to be held hostage, you know, was a tough decision to make, but a decision in hindsight that saved CHFA in excess of $8 million. So, you know, I can't underscore that enough. You know, thoughtful decision and approach to, you know, difficult market circumstances, you know, played out in CHFA's favor, such that when we sold bonds back in July, and if we can go to Section A, that'd be great. So let's start on this page. But when we sold bonds back in late July, CHFA ended up selling that PAC bond at a 1.08 yield and not a 2.35% yield, you know, in and around that range as it was in late April in the height of the dislocation. So, you know, obviously that translates directly into spread earnings for CHFA and lower mortgage rates for, you know, first time and low and moderate income home buyers in Connecticut. Obviously, you know, primary mission and goal of CHFA. So, you know, the sale and the lead up and the decisions made, you know, over the course of a couple of months really benefited CHFA. So if we can stop right there on the screen, you know, with respect to the actual sale, again, you know, investors showed up, investors paid, you know, significantly tighter spreads in July than they were willing to pay in April. We ended up with 78 million of retail orders within the state of Connecticut, an important distinction because obviously, you know, retail is important as part of the construct of CHFA's underwriting team. So strong retail production. There was 357 million of institutional orders, so strong institutional interest as well. I think both of those things underscored what Hazim and team expected to happen, which is we knew investors would be there. We knew CHFA has a very strong credit, well received in the market. We just didn't want to pay those inflated prices by chasing the market back in April and May. So investors did show up, allowed us to push the market lower from where it had been in previous weeks, and so pleased with that outcome. With respect to, if we can go to the next section, timeline. You can sort of see where interest rates were in and around the July timeframe, both pre-pricing and post-pricing, with that yellow line being the 30-year non-AMT housing bond. So we did have a little bit of a dip in the timeline there, which CHFA capitalized on. Again, sort of looking at this from a holistic standpoint, I think the finance team and led by Hazim and Ed did a great job of finding that pocket in the market where we could capitalize on investors. If we can move on to section D here, we'll give a little eyesight on the.
Which page is that, Corey? Do you know?
Yeah, it's.
Oh, section D.
Yeah,
Okay.
section D.
Okay.
So right here, just a little bit of eyesight on investors. Obviously, 39 institutional investors. Hazim could tell you more than I can. I think it's a fairly healthy depth and breadth of institutional investors that participated in the CHFA credit here on this particular sale. So some really big names, supporting the CHFA transaction from an institutional standpoint, and obviously, investor distribution there. And then, finally, I'll just, if we go one more page behind this, next page. So this is, an order and allotment summary. Again, just one back if we could. There we go. Oh, one down. Perfect, right there. So this is just a recap that shows you by maturity and retail versus institutional breakdowns that we always look at, and Hazim and Ed look at along with Lamont with respect to managing bond structures, where bonds are placed, where we sell bonds, and you can see where there was interest and where investors stepped in greater demand and where things were lighter. So overall it was we think a home run for CHFA in the context of we could have chased the market in April, but RBC again, one of the reasons were one of CHFA's senior managers and a long-term partner here is because we didn't shy away from the need or the ask at a point in time when global credit was under a big siege and a big demand, and we prioritize CHFA in this mix, which is why we're on your team, and we're pleased to be able to step up and fill that need, and then also do the takeout financing and execute this bond sale. So with that, happy to answer the questions.
Questions?
Yes, I just have a comment. Well done. That's great news.
Yeah, I'll
anything else
actually,
you'd like to add there?
No. It's all you, Corey.
Wow.
I think it is a team effort. I think the committee remembers, like when we were back in April and May, there was a lot of uncertainty. There was concern about forbearance, concerns about defaults, concern about where, what would be, whether or not we're going to see a light at the end of the tunnel. So the only thing I can say is, the team worked really hard, reached out to its syndicate, reached out to RBC, and we came out with the best financial vehicle at the time, and this is essentially the result.
Really good job. Very happy with that. It's a great outcome in a volatile time. Thanks.
Okay, the next one is Allison. You're going to go through the financial reports. I'm going to try and find the thing and so that I can share the screen.
Okay. Well, good morning, all. Before you are the August monthly financial reports. Investment interest and mortgage loan revenue shortfalls continue to be driven by the decrease in single-family production and the increase in the single-family loan prepayments. The amount of single-family loans originated during the first 8 months of this year is approximately $140 million lower than prior year. Single-family loan prepayments are $70 million higher than the same time period last year. So the net effect of the two is a portfolio reduction of approximately $210 million. Now, investment interest shortfalls are also being driven by the decrease in short-term investment rates. The average stiff rate for 2020 is 1.42% lower than it was last year. On the expense side, bond interest expense is below budget by $8.7 million and is $3.9 million lower than prior year. The variances and the reason behind those haven't changed from the last several months. Administrative expenses are coming in $4.6 million under budget and $1.5 million less than prior year. When you exclude salaries and bennies, or $16.4 million, the current year-to-date expenses are $1.1 million lower than prior year's admin expenses. Do you have any questions?
Questions from the committee?
I'm assuming that the cost savings is really COVID related and sort of.
There are several COVID related items besides the salaries and bennies, we have about 13 vacant positions right now. On the non-salary items, we're seeing a lot of savings in staff development. Folks who were planning on attending seminars and conferences, obviously those were postponed or turned into virtual conferences where we're not having to, fly folks out and pay for hotel rooms for virtual. Other items like counseling fees, we're seeing a reduction in that. The counseling sessions, they've postponed or suspended the in-person classes due to COVID. They switched those to virtual. We're still trying to catch up on the billing on those. They're having a little trouble trying to figure out how to process those. But there is some savings there as well because of that.
And we also recognizing some savings for the lack of foreclosure, because we do have a line item to pay for foreclosure expense, and since foreclosure is currently suspended, we have an unexpended amount.
Mm-hmm.
That won't be savings, right, Hazim? I mean, that's to some extent will be deferred.
Yeah, it's essentially deferred.
I have a question. When will you start for the next calendar year budget process?
We have already begun internally. So what's happening right now is we are planning to present the capital study, and I believe all of the members have accepted. So that presentation, along with the feedback that we get from that capital study, we're going to tweak what we are proposing to the board. So the plan would be to provide members a draft of the 2021 budget at the October meeting.
Right, is that the board meeting on the 13th?
Yes, that I believe so. Yes, that's the day after Columbus, right?
Columbus Day.
Yeah. So CSG is going to present its report, and then from there, CSG is going to solicit, or we are going to ask members to provide feedback, and depending to that feedback, we're going to fine tune the budget.
Okay, thank you.
Okay, if there are no other questions, I will hand it off to John Chilson.
Good morning. For the month of August, the authority purchased 132 single-family loans totaling $25.3 million, of which 113 loans were with a balance of $21.2 million were securitized, or 85.6% of our production. The remaining 19 loans totaling $4 million were whole loans. The average loan size for August was $191,300. The month-end mortgage-backed security portfolio at the end of August was $2.4 billion, which was a decrease of $11.4 million over the prior month. And while our whole loan portfolio in the month of July also declined by $11 million, or 86 loans, to end up with a month-end portfolio balance of $1.55 billion. The overall delinquency rate for July month over month increased by 39 basis points to 2.7%, while the carrying balance for loans in foreclosure year over year decreased by $7.1 million to $36.7 million, for the total number of loans in foreclosure declined by 58. For the month of August, the authority also funded 58 down payment assistance loans totaling $374,000, with the average loan size of $6,400. Approximately 44% of our August borrowers took advantage of the down payment assistance program. Forbearances in the single family portfolio for the month of July, the whole loan forbearance is declined by 418 loans over the June high of over 1,600 loans. So we ended up with 1,229 loans in forbearance for July, comprising of $916,000 of P&I payments on UPB of $153 million, or 8.8% of our overall portfolio. Approximately 44% of those July forbearances still made their July payment. For the month of August, we saw an additional decline of 306 loans down to 923 loans, comprising of $674,000 of P&I payments on a UPB of $115 million. Our multifamily portfolio, there were no new loans closed for the month of August, so the portfolio decreased by 3 loans to 541 loans, with a balance of $1.24 billion. The permanent loan delinquencies increased by 4 loans to 9. Construction loan delinquencies were 1 loan. The combined delinquency rate was 2.69%. And for forbearances in our multifamily portfolio, to date, there have been 7 projects comprising of 8 loans that signed forbearance agreements, which involve $134,000 of monthly P&I payments on UPB of about $24 million, or 1.9% of the multifamily portfolio. Any questions?
Yeah, I have a question. On the forbearance, is it too soon to tell whether or not there's going to be some long-term impact of that, or is this just a short-term forbearance that's going to be over and then moving on?
It's going to be very interesting to see. We've come up with a number of options. We've provided the servicers to offer the borrowers who have a balance of forborne payments, and depending on how successful individuals are working out with those unpaid payments, which I think the options we provided are generous, including one where if no other options available, they can defer the payments that they did make to the end of the loan, interest-free. That's very similar to what FHA and Fannie Mae and Freddie Mac have offered as well. But I think in those cases, the outcome will be okay. The only concern I really have with the loans in forbearance are those loans that were already delinquent prior to the beginning of the forbearance program. Because what's happened is you can imagine a good share of our delinquent loans asked for forbearance and were granted forbearance. So that's made their delinquency greater, and their options for working out will be much more challenging. If we're successful, it'll be a loan modification. If it was heading for foreclosure already, I'm not really sure there's much help we can offer there.
You know what that universe is? How many fall into that category of already being delinquent before COVID and before the forbearance?
Yeah. When you look at the overall, like I said, in July, there were 44% of those July in forbearance were paying their July payment, which means they were current. You know, that leaves us roughly a little more than 56% that either are in forbearance and current otherwise or delinquent. I think maybe it'd be about a third of those in forbearance were already had pre-existing delinquencies.
Under the forbearance program, I thought, and obviously this isn't the case, that we weren't forbearing if, or I guess that was on the multifamily, we weren't forbearing if the loans were not current prior to COVID.
No, that restriction exists for some of the options that we would offer people coming out of forbearance. But anyone, and as you know, under the CARES Act, anyone on a government loan, which we modeled our program after, could ask for forbearance, not have to provide any reason for, other than the fact that they were impacted by COVID. There's no substantiation provided.
But that was not my understanding. My understanding was there was a caveat that you had to not have been more than 30 days or 60 days or something like that past due.
Yep,
I mean, there's no foreclosure, but foreclosures were frozen, but
that was true. Yeah, that was true for offering the what they call the payment deferred option, where the FHA is agreeing to do what I had mentioned earlier, taking the unpaid loans, monthly P&I payments, and adding them to the end of the mortgage. You had to be current as of March 1 to have that option for working out your forborne payments.
yeah, but I think we're all saying the same thing. I mean, if you were past due more than whatever it was, 30 days, 60 days, whatever the number was, once this whole thing is over, that population is still going to be in dire stress.
That's exactly right. Yeah, that was my point.
That does not going to prevent them from some action.
That's right.
Versus if you were not past due, or you were past due less than the days, whatever the days were, you're going to be given a whole bunch of different options that can bring you up to date.
That's correct.
Okay. Also, I have a question. I mean, the economy is going to change. I mean, the economy has changed, right? If you're a restaurant owner and you're self-employed, you had a mortgage with us, there's a big high possibility your restaurant may go out of business, right? People who were in the hospitality industry, hotels and so forth, some of those jobs are not going to come back. And maybe it's way too early to tell, but do we have any data on the people that have been asked for forbearance of the type of work that they do, or do they fall into any of those industries that we don't think is going to recover anytime soon? Not because of their fault, that's because the economy has changed because of we're not, look what we're doing. We're not traveling, right? So if you own a gas station, your gasoline sales are much lower, right? And anything else that goes along with that convenience store.
Yeah, that's a good question. I've often wondered that myself. To answer your question, we don't have any of that kind of data. The only thing, for one thing, our average loan balance is we have a fairly seasoned portfolio. And the only time you'd have that information is the initial application.
So our system doesn't capture that and maintains it from a historical perspective?
What we capture is the income. I don't think that we capture the actual type of employment.
We do. I think, John, you mentioned this. We do capture it in the beginning, but we do not have, or we do not track what their current position as of say today.
Right, or income.
Of course, because you don't get updated information. But my question, but even if you did capture, you could still do some extrapolation, right? Some guesstimates, right?
Right.
The purpose of allowance for bad debt.
Right. Yeah,
I was just wondering if we had that, because unfortunately the economy has changed, right?
Right.
There are some industries that are not going to recover 100%.
That's right.
And not going to look the way they did before. The same way that there's some new industries that were created, right? Or some industries have done better.
Well, it's actually a good segue to Sherry, because she does do a lot of tracking for the authority, and she's very close to what's going on when it comes to the economy. So Sherry, you want to touch on it a bit?
Yeah, we actually have looked at this a little bit. We have a report based on sort of that extrapolation that you're talking about. It's not a perfect science, but I can sort of dig that up, and maybe we could show that for you sometime either during the month or at the next meeting. Because we've been concerned about that too, is what type of jobs are just never coming back, what type of jobs are going to recover quickly, what type of jobs are going to recover a little bit slower. John and I talk often about the different types of what's happening with delinquencies, so we could definitely bring that to the board if Hazim, if you want that to happen. Do you want me to go into my report, or?
Yeah, I think
Okay.
I think so too. Unless they no one else has any questions. So Sherry.
So for the monthly tracking for multifamily, what you're going to see is 3 developments that need more funding or need new funding. The first one is New Park Avenue, and this is in West Hartford, and it's right near the Connecticut Fast Track. So it's a TOD development. It's a family development, new construction, very walkable, right in the neighborhood of tons of stores and stuff. And then Willow Creek, which is part of the old Westbrook Bowls. It's a revitalization project in Hartford. And Market Square in Newington, which is an existing elderly, and we're doing rehabilitation on it. All of those have strategic impact to CHFA and are important projects. So you'll talk more about that at the board. In the single family area, as Allison talked about, there are 132 mortgage loans and 58 DAP loans. These are both down from last year, which I think Hazim is going to talk a little bit about in the next discussion. And the DAP loans, just so to note, are now 42% of all our loans that we've been doing. Last year, they were at 30%. So our loans are lower, and the loans that we're getting are mostly utilizing our DAP program, or more utilizing our DAP program. In the prepayment area, we're seeing higher numbers because the housing market actually is doing very well in Connecticut, and many of our people who have loans with us are probably selling or refinancing and moving up to newer, bigger homes. And that's sort of what we hope will eventually happen with all of our borrowers. So it's good in many ways, but it does affect revenue. Any questions?
Any questions? All right.
Okay, Joyce, on the internal audit report.
Good morning. Included in your package is an update on the 2020 internal audit plan. Overall, there's been a shift in our resources from assurance, just audits, to more consulting activities. We've had a number of requests from management. One was to add an audit to the plan, as well as additional consulting assignments. The net effect of that will be that we will more than likely defer certain audits from the original plan to 2021. So since we last spoke, in terms of CHFA audits, we completed an audit of payroll administration. We reviewed controls over the processing and the payment of payroll and employer benefit expenses paid to the state of Connecticut. That's about $25 million, actual expenses year-end 2019, as included on the operating budget of the authority. Just to give you a flavor, we made a number of recommendations, including resuming a reconciliation of employer fringe costs to the authority's detailed records, employee benefit records, rather than just placing sole reliance on the accuracy of the payroll report that comes from the state. Recommendations relating to correcting vacation accruals in the state of Connecticut payroll system, referred to as Core CT, and enhancing reviews of payout calculations when employees leave, and improving reviews over employees' time. Management is in the process of implementing a number of these recommendations, and they have actually fully implemented about a dozen prior to the issuance of the audit report. The audit that we added to plan was Housing Tax Credit Contribution, or referred to as the HTCC program. This was at the request of the CEO. We completed phase 1 of the audit, which reviewed controls over the application review and allocation processes. That is about $10 million of tax credits allocated annually by the end of the year. The scope of the audit did not include compliance monitoring of this program, as management is implementing a new program at this time. When that is fully implemented, we will then perform a review. We made recommendations to approve the effectiveness of the program and the related processes. A key area is how to effectively incorporate compliance monitoring results into future rounds. As I mentioned, this was at the request of management. They intend to perform an overall review of the program and intend to incorporate our recommendations into that review. There's an overall target completion date of the end of the first quarter, 2021. We have 2 audits in process in accordance with the plan. The audit of the monitoring of Dovimule, the authority's single-family loan subservicer, and we are performing a follow-up audit of the LIHTC allocation phase 1 audit that we completed at the end of last year. Switching to servicer compliance reviews, just for background, we do not an audit, it's a compliance review, which focuses on compliance with the contract and or key insurer guidelines. We do that for some of the top servicers that we have in the portfolio, as we view them as a significant outsourced business function. Initially, with COVID, we did delay them slightly. We now have 2 desk reviews underway, that of Santander and Berkshire banks. Those were incorporated in the 2020 plan. We anticipate that they would be completed by year end. As previously mentioned, we are performing a little bit more consulting activities. The focus this year has been assisting management with providing an additional level of review on a sample basis on some of the tax credit rounds. So we will be creating the 2021 internal audit plan in the 4th quarter of this year. If there are any audit areas of concern that you would like added to the audit plan, please let me know. I'm happy to answer any questions at this time.
I have a question concerning your mortgage servicer.
Yes.
As part of your audit plan, do you go and check with like CFPB or even the Department of Banking to see if there's any actions or any actions were taken?
We do, Commissioner. We actually we have a monitoring. We monitor the various aspects with all of our servicers. So we have news alerts that come in, but as part of, like, I want to say quarterly process, we actually go to the banking department website and check those. And if there are any areas of concern, we bring it forward to management and we make a determination as to whether we need to change the plan, add to plan. So yes, we do that, I want to say at least quarterly.
I don't know. This is more of a legal question, and as Commissioner, I'm somewhat embarrassed is not the right word, but I maybe should know the answer, but I don't. There may be stuff that is not published yet, meaning that if there's an ongoing investigation or examination that has not finished, you may miss it by a day, you may miss it by a week, you may miss it by a month, you know? So I don't know, we have agreements with other entities that we cannot say, look, the entity has violated X law without doing a final conclusion, but we could say we have some issues, right? So maybe at some point the lawyers could get together and see how that could be worked out.
Sure. Basically, it's a monitoring process that we have in place, and it's based on public information.
Okay.
I have a question about the payroll and fringe benefit audit.
Sure.
Seemed like a decent number of recommendations that came out of that. Curious when the last audit of that section was done.
I want to say it was around 2014. It was a while ago. We spend a lot of our resources on the business processes, so multifamily, single family. So I guess I want to say it was a while ago. A fair amount of time. Yeah.
Do you do a comparison, or in this case, did you do a comparison of what that audit revealed and what this one did to see if there were repeated recommendations?
I would say no repeat recommendations, but I would say this audit included more recommendations than in the past. I think some of it had to do with the implementation of Core CT, which was a while back. But I would say a lot of the recommendations had to do with making sure that was done appropriately.
And it looked like there was a bunch of them that I kind of recognized from when the state auditors do their reports of other. I see similar types of things come up in other agencies, but I don't remember seeing any of these pop in their audit of CHFA. And is that just, are they just doing a smaller sample and they're not catching those things, or how do you explain that? Or do you know?
That's a good question. I don't really know, but I will tell you that when we do our audit planning, we do a pretty broad brush of what we need to cover. So we monitor state audit reports routinely for anything that we think that could potentially impact the authority. And I either if I think it's important, I'll talk to management as it comes out, or I will incorporate it into the review. And so, yes, we did a review of all the state audit reports, and we did adjust the audit plan to make sure we've covered everything that they deem important.
Okay. Yeah, my question is more about why some of these things didn't show up in the state auditor's audit of CHFA.
I don't know if they have different levels of risk or they perform different audit procedures based on how they view the risk to be for each agency. That would be a potential guess, but I don't know why they haven't appeared in state audit reports.
Okay.
But our goal
on a
is
separate note,
to
do we need
prevent.
to?
Our goal is, yeah.
No, I was just,
goal
I'm
is to
sorry, I'm
prevent.
going off topic here, but it looks like we may run past 10 o'clock. Do we need to let the commissioner know that we may be late for the board meeting?
Amy, can you let Nandini know?
Yep, I'll take care of that right now.
Okay.
Thank you.
Hi, everyone. This is Glenn. I put a note in the chat, but I'm going to have to jump. I can't make the board meeting. I have another important agency meeting. So hopefully that doesn't mess up quorum for this meeting.
No, I think we're good, Glenn. Thank you.
Okay. Thank you.
Jared, are we okay to go to the next item?
As far as I'm concerned, yes, unless anybody else has something.
I had a question. So what happens next? Is there sort of a final step that sort of looks to see how many of the recommendations have been implemented and what the impact of that is?
Yeah. Yes. So from the audit report, we get the initial read from management on implementing the recommendations, and then we track them. We follow up with management probably 2 to 3 times a year to either get information to close them or pen them pending the next review, and or adjust the target dates if they feel they're running a little behind. So there is that process that we follow, and then if it's a high audit or something we view that's a little bit more critical, we will actually do a formal follow-up which lists all the recommendations and shows you the status, whether they be open, closed, open or closed. For example, we are working on one now for LIHTC allocation because we viewed it as a critical function, and I think management has made a lot of progress. So we're working on that one right now. So the next report, you'll actually see what a follow-up audit would look like.
Great, thank you.
Mm-hmm.
All right.
Okay. So the last item on the agenda is about an alternative financing or funding strategy for single family. So just want to share with the committee that, since we've been talking a lot about COVID, something else is happening within the market space. Back in back in March, I should say, the Federal Reserve, in connection with the COVID, they restarted their bond buying program by purchasing agency mortgage-backed securities. What this does, or what it did, was it, in essence, caused a high demand for MBS in the open market because the Fed was buying it. So because of this demand, it created, it's not really a new product, but it's more of this movement within the housing finance agencies of a product called a collateralized mortgage obligation or interest-only strip. I'm going to show to you, or I guess in the packet, I did produce 2 diagrams to describe to you basically what it is. So in essence, in a bond financing, when we sell bonds, we would then take the bond proceeds to make loans, either for single family or multifamily. So in this situation, it's more for single family. So the loans will either remain as loans, or we will take the loans and we will wrap it in the mortgage-backed security for securitization. But whichever vehicle that we take, the receipt from either loan or the mortgage-backed securities will be used to pay the bond investor. In this particular structure, what it does is you take that same MBS, but instead of you are pledging it and using it to pay bond holders, the bond holder is coming later, where a purchaser will buy that same MBS and then will return to you an interest-only strip based on the cost for it to then sell that same MBS to another investor. So the diagram here will essentially show that, so the bond investor and the purchaser is essentially the same. So in this particular situation under the bond program, if we sell a bond and then the bond will have a yield of say 160, then the return will be about the 90 basis points for a mortgage-backed security. But based on the indication that we receive, if we follow the interest-only strip, we actually going to experience a lower cost of funds, or about 1.4%. So we essentially just increase our annuity by 0.2%. In addition to being able to generate more spread, this execution does not require us to use volume cap. As you know, we use volume cap to issue tax-exempt bonds to achieve the lowest cost of funds. But then at the same time, volume cap is also needed for multifamily to raise the low-income housing tax credit equity. So we think that this vehicle will help solve not all of it, but at least relieve the pressure for the need of volume cap. We also will not need to pay cost of issuance. As you know, we pay about at least a point for every bond sale that we do. We also will reduce our variable rate exposure because for us to get the 1.6% that I just mentioned for a typical bond financing, we have to sell variable rate debt in addition to the fixed rate debt to take advantage of the yield curve. And last but not least, it is a quick execution. So the way it works is the mortgage-backed securities that you have on hand is offered to select broker dealers that is approved to engage with CHFA, and then depending to the prevailing market price, you then can decide whether or not you want to sell it to them in whole, in part, or not sell at all. Now, it sounds all good. Why are we not jumping on it and doing it all the time? One, of course, is mortgage-backed security. So not all of our loans that we make from single family ends up in a mortgage-backed security. So for it to become or get securitized into mortgage-backed security, it does need to satisfy the GSE, DU, delegated underwriting, or the LP underwriting requirements. We also have to pay a guarantee fee of 0.45%. So it may not, we can't, it's not available to all our borrowers. So that's number one. So there is a cost benefit evaluation there. Number two is on this future appreciation. So what happens is when we sell the MBS and then we get something back, the MBS that we sold, we're done. We're no longer going to get it. So what happens is if say that the value of this MBS that you sold in the past goes up, you can't take advantage of that value. So you will lose that flexibility. Unlike in the bond, when you pledge the MBS, you continue to realize that valuation. So you may have options if you decide in the future whether or not you want to take down the bond, sell the MBS, take the cash, so on and so forth. And then last but not least, the value for MBS is actually currently being supported by the Fed itself. So right now it's good, it works because the Fed continues to buy a huge amount of MBS in the market. Once it starts pulling back, then we will see that the value will decrease or may go away altogether. So the conclusion here is we just want to let the committee know that this is something that we're looking at. If it makes sense, we will pursue it. But then that does not mean that we're not going to issue future bonds. We just presented an action item wanting to issue new bonds because the existing bond, the new bond, it does provide other benefits in terms of the ability to capture more savings and then to provide targeted programs. So this is also a part of our strategic plan. Jerry and Heidi were part of the smaller group talking about and discussing on new financing product execution. So we just want to, again, bring this to the committee, the things that we're looking at, and it may impact how we conduct business going into 2021. So I'll be happy to answer any questions the committee may have.
Asim, would this have any impact on potential costs for swaps?
No, there is no swap in this situation.
Because of the variable rate, still there's no swap?
No, the variable rate is
doing a transaction that includes swaps. We do this one, so therefore there's a potential savings.
Yes. So the benefit is we essentially will be reducing our variable rate, hence we'll be reducing our swap exposure.
And potential cost.
Yes, potential cost.
Most of the cost savings that we talked about today is really not, it's potential savings because we didn't spend the money.
Right. So in this particular situation is we're saving more than that. Yes.
Asim, how does it affect the future income versus doing the bond issue? My understanding, the bond financing gives you annuity income over time, and you say that this also does.
Correct.
And this is still giving you an annuity income over time because you're not selling the principal, you're just selling the interest? Why is
right.
that?
Well, so the way this thing works is like, we'll just give simple numbers. Say that you have a 3% mortgage rate, and then you have a 2% bond rate, and then you're going to get an annuity of 1% over the life of the loan. So if the loan pays off, then you pay off the bonds, and then your annuities drop, right? In this situation, under the IO strip, assuming that the MBS is also 3%, because I don't want to go into the whole guarantee fee. Say that the MBS is 3%, and then somebody is willing to buy that MBS and say, I'm willing to buy it, but in return, I'm going to give you an interest-only strip of 1.2%. And then what they are going to get back is the difference between the 3% and the 1.2. So it will be the 1.8. So the cost to them is 1.8. And then because the 3 minus the 1.8 is 1.2, we keep the 1.2 as an interest only. So it's actually still the same. So what will happen is the loan or the MBS will pay back P&I, but we are going to keep the 1.2 over the life of the loan within the MBS. So once the loan pays off, the MBS pays off, the interest only pays off. So it's more of a rate play more than anything else.
You still get your income over time.
You will get your income over time. And the interest only is backed by that same MBS. So it's not like you're getting like a Joe Schmo guaranteeing the interest only strip. It's the same MBS that is paying your interest only strip. So if it's a Fannie Mae MBS, that's what's paying your IO strip. If it's a Ginnie Mae, that's what's paying your IO strip. So it's literally a pass-through.
Hazim, it seems to me that what makes this possible is basically this quantitative easing that the Fed is doing to support the mortgage markets.
Yes.
Right. So your investor is different than your taxes on bond investor, which is another advantage in that you are diversifying your investor base.
Correct.
And it's easier to do. It's like a simpler step. But I guess the other thing I'd ask you to think about, I think it's very clever. And so two questions. One is who sort of came up with this? Does it come from the advisors or does it come from the dealers?
It actually came from the dealers.
Right, because they want to do the strips. Which
they want to do the strip, and of course, and Corey is on this thing. Everyone is trying to come up with the next new thing, but the reality is, it has to make sense to them. Like somebody has to make money. So we know
Absolutely.
that there's some fluff in this whole math, but what we're trying to do is we're trying to compare and trying to make it as simple as possible to ensure that this alternative execution is bringing value to the authority. And if we think that is not, then we're not going to pursue it.
Oh, I think it's a good idea. I don't misconstrue my questions. I think it's actually very clever. But I assume that the dealers, and you're right, they are only going to do this to make money, which is fine. The dealers basically will make a markup in essentially when they purchase the MBS and chop it up into the IO strip and the P&I strip, that when they resell to their investors, there'll be a bond markup. So, which is fine. We just want to make sure that we know what that is, and in your process of awarding that business, you have some transparency. And I guess the second thing is, given that you lose to some extent, when you look at this, it's like looking at a non-callable versus a callable bond to some extent. And so you're losing this you're losing the capture of the potential appreciation of the mortgage-backed security. There should be a way to quantify that in some kind of like option adjusted way. So I don't think it changes the analysis at the end of the day, given that I do think that this is going to, it is going to probably produce savings and has all the advantages that you talked about, not having variable rate, not needing swaps and all that. But we should probably try to quantify that loss of appreciation in some way, just so that when you look at when you do the analysis, it's not just, well, we lost appreciation.
Right. No, so we've been looking at different states that have pursued this execution, and one of the things that they look at is the prepay speed and compare against the OIS curve. It all comes down to what variables that you think is relevant to the whole analysis. We are in this unprecedented low rate environment, so the valuation, the appreciation will go up if interest rate continues to go down. So then it all comes down to how low can it go before you actually say, unless interest rate is going to go negative, which no one is going to say that is not possible because it's happening elsewhere in the world.
Hazim, it's Tim. You've indicated a couple times that you're kind of looking at this. What's going to be the trigger for the decision, and is that a decision that the committee has to vote on, or is that just something that you guys will automatically do?
Yeah, so we can at the present time we can pursue this execution based on the approved broker-dealer list that we have. We are working with 2 at the moment, and Lamont Financial, who is acting as our financial advisor, is evaluating the pricing. So yeah, Tim, going to your question, yes, we are looking at it, and number 2, no, we're not looking for the committee to approve this execution.
Okay, and so you expect to pull the trigger or make a decision before the next board meeting, or what's your time frame?
We think that is going to be before the next October meeting.
Okay, Thank you.
But it would still require a resolution of some sort by the board prior to execution.
We are going to present a resolution to the board in October to approve a master trade agreement, the MSFTA. But the execution that we have currently with these broker dealers, they do not require one because they're already part of our syndicate. But because we want to expand and add more participants to bid on the price, we are going to seek approval from the board in October.
Azim, what do you anticipate, just talking about it as like a percentage of the MBS portfolio, have you set sort of internally like where you might cap the amount that you would do through this new structure, or have you talked about that at all?
Yes. We do have a framework. So currently over 90% of the loans that we make, we do securitize. So that's one. So we do have some understanding about the pool that we have going forward. We're not currently looking at selling MBS that's currently pledged to bondholders. So this is more for future business. So that's point number one. Number two, we are also tying this execution as part of the capital study, because one of the things that you will hear on October 13 is ways where we can improve our net margin, but also finding ways where we can alleviate the need of volume cap, because that's the other request that we receive, or the feedback that we receive from board, trying to do more multifamily, but the challenge doing more multifamily is trying to figure out how we can find alternative financing that do not require volume cap. So that there is all this competing needs. So one of the things when we were looking at this, we're not, that's why I was putting in the conclusion that it's not like one and done, or it's not like when we do this, this is what we're going to do forever, because we still don't know. The way we're doing this is the new polls that we get on a monthly basis, we are going to evaluate whether or not we want to put it and pledge it to the bonds, or based on market condition at the time, it makes sense for us to pursue this alternate execution. So the idea is you don't get stuck based on old data or historical trends. We are going to evaluate as it comes. So we get the best course of action. The other thing that what we are also not putting here is, or I didn't show as a benefit, is it's also a good way to hedge against interest rate risk. Because one of the things that we are currently doing is we are taking down, making loans, making reservation to make loans, but then we may not have the proceeds to fund them with, or we don't have a permanent financing, I should say. So we're using warehouse financing. So in an event, if when you make a loan today and you reserve it at a particular interest rate, and when you sell the bond interest rate is much higher, then you are exposed to an interest rate risk. So there are other things that goes on in the calculation to ensure that what we do makes sense for the authorities' strategic plan. So this is not just like, okay, let's just make a quick buck and then just call it a day. So there's a lot of things that goes into it.
And I think you mentioned something earlier about a 0.45% fee.
Yes.
Are there other, and in the benefits it talks about no cost of issuance, but what are the fees and how would those compare to if you're doing versus doing a typical bond?
Yeah. So for those who are familiar with the residential mortgage securities, 0.45 is a fee that Fannie or Freddie charges when you put a loan into a security and they back the future losses. So this 0.45 is equal to the amount that we just talked about earlier during this meeting when I touch on we are currently not pursuing any foreclosure. So we, on the operating budget side, we set aside $2.5 million to cover for any foreclosure expenses and losses. On the flip side, if you don't want to pay that $2.5 million, you then pay Fannie or Freddie 0.45% on the UPB, and you are now pushing that future losses to them. So it all comes down to the type of loans that you make. You feel that is a loan that you want to take the risk on, or do you want to push that risk over to the GSEs, to the government-sponsored enterprise? And then along the way, you also have, and Jerry touched on this previously in prior meetings, about rating agency haircuts. So rating agencies, they like if you put stuff into MBS versus you are leaving them as loans. But to leave them, to put them into MBS, rating agency also has credit score overlays, certain LTV requirements, which may not fit into our mission from time to time in an event if we want to pursue and provide special programs or targeted programs. So that, it's a very dynamic, trying to understand what type of loans that you're going to make, what type of loans that you're going to pledge to the bonds. If you leave them as loans, CHFA is taking all the risks. If you put it into an MBS, you're pushing the risk away, but there's a payout. You have to pay for it. So that's what's happening.
So, and are there other, I guess I'll call them professional fees, or that we pay to the financial advisors? Is it going to cost additional money, or are there other transaction fees related to it?
For the IO, no. For the IO, no. Yeah. So the cost of issuance, what happened is we are not going to pay lawyers' fees. I feel bad for bond counsels who's on the phone. We're not going to pay underwriters' fee. And then we're not going to pay rating agency fee.
Okay.
Hazim, though, you will pay a fee in that there's going to be a trading spread that the dealer is going to charge. It's going to result in a lower annuity for us.
Right. Absolutely. So the fee is already baked in. It's no different than when you enter into a swap and they will say, okay, this is the mid-market, but plus the spread, here's your all-in cost. So the idea is the all-in has to work for us. But when we present to the committee, when we say a bond yield of 1.6%, we pay cost of issuance upfront. So it's actually, bond yield plus whatever that you expend for that current year. So we just save 1 point off the bat.
And I'm going to request that you mention this in the board meeting.
Sure.
I think it's something that's good for the full board to know. I know right now it's scheduled to be under the consent agenda, which we don't usually have a lot of conversation about, but please, mention this, give an overview of it, so that they know that this is happening.
Sounds good.
Okay.
So the last item on the agenda is the Finance Committee minutes. Before the committee takes a vote on it, I just want to mention there's a typo on the minutes where we accidentally left off Franklin. He was in attendance at the last meeting, so we are going to fix that.
Very good. All right. Is there a motion to approve the minutes from the July 30th meeting?
Tim Hodges, I move with the correction.
And is there a second?
Yeah, Sarah Sanders.
Okay, we have a second. You want to do the roll call?
Sure. Jerry Abrams.
Aye.
Tim Hodges.
Yes.
Catherine McKinnon.
Aye.
Jared Schmidt.
Aye.
George Perez.
Yes.
Sarah Sanders.
Aye.
And then Glenn Thames left.
Is there a
Okay.
motion to adjourn?
Moved, it's Tim.
Well, second.
Moved and seconded. I think we can do this by voice. All those in favor say aye. Aye.
Aye.
Any opposed? We are adjourned.
Thank
Thank you.
you.
Thanks.